Hello everyone. I want to walk you through a brief example of how to record transactions, and we're going to do that by going through the example that is on page 12 of the first chapter of the textbook. Before we do that, I want to mention that when you're recording the financial information for a company, all of that information is contained within that company's accounting equation. The accounting equation, which is introduced on page 11 of the textbook, is assets equal liabilities plus owner's equity. And owner's equity consists of two components, paid-in capital and retained earnings. What this accounting equation says is that on the left, we would keep up with everything that the company owns, and by definition, an asset is something that will give us a future benefit. So things that we own that we can use in the future to benefit the company, increase profits and so forth, things like land, buildings, vehicles, equipment, a manufacturing facility, all of our store locations, the inventory that's in the store, all of that would be the assets that the company owns. And then the question is, where did the money come from to get those assets? Well, on the right side of the accounting equation, it tells where the money came from. And there are three broad sources of financing. You can borrow the money from other people, which means that you have to pay it back. We call those liabilities. Or the money can come out of the owner's pocket. We call that paid-in capital. So that's the money that the owners invest them out of their own pocket. It might be one owner, it might be several partners, it might be hundreds of stockholders, but the money that they invested we call paid-in capital. A lot of times in the examples we'll refer to that as common stock because that's what the owners are getting when they make that investment. And then finally, our ultimate purpose is to make a profit, and once we do make a profit, we can either keep that profit in the company to continue to use that profit to grow, or we can distribute that profit to the owners in the form of dividends. So this last category is called retained earnings, earnings that are retained in the business. That would be the profits that are plowed back into the company to finance growth. If we don't retain the earnings, that means that we are distributing those earnings as dividends to the owners of the business. So the accounting equation will always be in balance because it's the same money on both sides of the equal sign. Here it tells us what we own, and on this side it tells where the money came from to get those assets, but it's the same money either way. Now we're going to look at the example on page 12, and what you might want to do is pause the recording for a minute and read that, or you can read it right here on the screen if you want to, and then you can start back into the discussion. And you can follow what I'm doing on the screen. You can also follow along in the textbook to see how this business situation is accounted for. So we're going to do this within the context of the accounting equation. However, before we get started with that, one question we need to answer is, what is profit? In the example here, a lot of times people, the common reaction when you think about profit is to focus on cash flows. So if you focused on the cash flows of this business, not counting the money that was going back and forth between the owner and the business, that would not be considered part of profit. But if you think in the first month, the business bought a $300 lawnmower, so we had $300 going out the door. And then all the money was collected from the customers in July, and so we had a lot of collections in that month. And then we didn't have any additional cash flows in the month of August besides those dividends that we were paid. So if you focus on cash flows, it looks like we have a very erratic business. We had a really rough start in June, fantastic July, and then, I don't know, like we quit or went on vacation or something in August. And really none of those things are true. If you think back to the scenario, we had a very stable business. We did the same thing every month. We mowed the yard once each month. And the only thing that was different was the fact that the customer was out of town and all the money was collected in the month of July. So, cash flow is extremely important and we're definitely going to keep up with it, but that's not how we measure profit. In accounting, we call this the accrual system of accounting since we're not just focusing on cash flows. In the accrual basis of accounting, profit is equal to revenues minus expenses. Revenues are the amounts that you earn from providing a service to your customer or selling them a product. And in the process of doing that, we incur various expenses, we use up different resources, and revenues minus expenses, that's what we call profit. And then we have two principles for recording those. The revenue recognition principle says to record revenues when they're earned. In other words, when you do the work. When you recognize revenues, you record revenues. In accounting, anytime you recognize something, that means you're recording it. So we mowed the yard once in June for $200, again in July, again in August. So every time we do that work, we're going to record revenues. So that's the revenue recognition principle. And then for expenses, we recognize expenses as the resources expire. In this case, as the lawnmower is depreciating. And you might think of it as matching expenses to the revenues that are being generated. In other words, we were using this lawnmower each month, and so we're going to match a portion of that cost to each of those months that we used it. So this company's, we would call this an income statement. Revenues minus expenses equals your profit or net income. And as you can see, it reflects a very stable, consistent activity over the whole course of the summer. So the income statement, what you're looking at here, is one of the financial statements that's produced at the end of an accounting period. So we're going to come back to this in a minute. But what we're going to do is go back to the original scenario and account for every transaction that happened throughout the summer, and then we'll stop at the end of each month and make a set of financial statements. So here's the month of June. And you'll notice across the top I have the accounting equation, and I've got some specific items listed within each category, and we'll talk more about them as we go. But in real life, you might have lots of different assets, and anytime you bought a different type of asset, then you would create a new column for it. So the accounting process is all about looking at a transaction and recording how did that transaction impact the company's accounting equation. In other words, what went up, what went down. So we're just trying to summarize the changes that have happened. So let's take it one by one. First, the owner invested $500. So cash, we added to cash, and we also added to common stock or paid in capital, that category of owner's equity representing how much was invested by the owner. We then took $300 and bought a lawnmower. So we subtracted $300 from cash, and we added $300 to the lawnmower. We have a new type of asset now, a lawnmower. Then we mowed the yard. Now remember, anytime we do work for a customer, we're going to record revenue. Revenue, anything related to income, is put into this last column under retained earnings. So revenues would be pluses and expenses will be minuses. So we did work, so we're going to add what we earned from the customer, $200, under retained earnings. And it's a good idea to add a label out here so we don't forget what that is. We did not get cash. They owe that to us. So we're going to add that to an asset called accounts receivable. Accounts receivable keeps up with the customer accounts that are receivable in the future. It's definitely an asset though, because we own the right to that $200. We've already done the work. They owe it to us. And we definitely have a future benefit because they'll be paying us soon. And so we'll collect that money. By the way, if it bothers you to record that before we collect it, you might be thinking, hey, sometimes customers don't pay us. That's true, but that's taken care of in a later context. So for right now, let's just assume everybody pays us. At the end of the month, we only did that 1 yard, and so now we need to recognize the fact that 1/3 of that lawnmower has expired. So we're going to subtract $100 from the asset lawnmower, and that portion that has expired now belongs to the past. We call that an expense. The EXP expired portion is an expense. So we're going to subtract depreciation expense, again under retained earnings. And then finally, we gave a dividend to the owner, subtracting from cash. That's a distribution of profit, meaning that's $10 of earnings that we did not keep. And so we're going to subtract that under retained earnings as well. When you get to the end of an accounting period, like a month or a year, first thing you want to do is add up your columns and make sure that your accounting equation is in balance. And you'll notice we have assets that add up to $590, and over here we don't have any liabilities, but we have owner's equity that adds up to $590, so we're in good shape. We're in balance. So this chart, all the pluses and minuses to the accounting equation, that's the context that accounting operates in to keep up with all the different things that are happening to our financial status throughout the accounting period. However, in real life, this chart could get pretty big, and nobody wants to look into all that in detail. So we're going to summarize all of this in a set of financial statements. And there are 3 financial statements. The income statement that we've already looked at is revenues minus expenses equals our net income. So in this case, we would go over here to the retained earnings column. You look through and pick out all of your revenues and expenses, and you put that onto the income statement. These are the revenues and expenses that happen throughout the month of June. So it's important on the income statement to indicate what time period you're working with. The second financial statement is called the Statement of Retained Earnings. And what it does is it summarizes what happened in this retained earnings column, basically explaining how we got from that number at the top of the column, 0 in this case, to that number at the bottom, which in this case is 90. And this all happened, again, throughout the month of June, so the same time period covered by the income statement. The formula for the statement of retained earnings is our beginning balance of retained earnings, and then add the net income, which we've already calculated on the income statement, so that net income is added to the statement of retained earnings. And then the only other thing up here in the retained earnings column would be the dividends. Dividends is not an expense of running the business. Expenses lower our profit. Dividends simply lower how much of the profit we're keeping in the business. So we don't subtract the dividends on the income statement, we subtract it on the statement of retained earnings. So again, it's beginning retained earnings plus the net income minus the dividends during that period, and that gives us our ending retained earnings. In this case, $90. And then the final financial statement is called the balance sheet. The balance sheet tells us what is the status of the accounting equation on this particular day. So the balance sheet does not cover a period of time like the other two statements. It just says today. In this case, June 30. This is the status of our accounting equation, and all the numbers on the balance sheet come from the column totals. So we would simply list out the assets, cash, accounts receivable, and the lawnmower. Our total assets is $590. And then down below, we would indicate what our liabilities are, in this case 0, what our stockholders' equity is. We had common stock of 500, retained earnings of 90. So the total stockholders' equity is 590. And so the total liabilities in stockholders' equity is also 590 since the liabilities were 0. So again, the balance sheet simply summarizes what the status of the accounting equation is at the end of June. So that's the end of June. Now we're going to come back to work and go into July. When we look at the accounting equation for July, all of these column totals that we ended June with, that's what we begin the month of July with. So those numbers carry over and they're at the top of the column. Okay, the first thing we did was we collected $200 as a payment for what they owed us from June. So we added to cash, and the accounts receivable now comes down because they no longer owe us that money. Notice that we are not recording revenue because we didn't do any more work for that. That work was already done back in June, and the revenue recognition principle says we record the revenue when we do the work. Next thing we did was we mowed the yard and collected $200. So anytime you do the work, we're going to add under retained earnings the revenue, how much we earned from that. So that'd be $200. This time we did collect the money, so we're going to add $200 to cash. So cash went up, and so did retained earnings. And then finally, since the customer is going to be out of town in August, we collected another $200 in advance. Now, again, we have not done that lawn mowing yet. We're going to do that next month. We owe them a service because they paid us in advance. So we're going to add a liability. It's called unearned revenue. We have not yet done this work. We owe them this service. If for some reason we never got around to mowing the yard, then we would owe them that $200 back. So it's definitely a liability. So I want you to notice that we collected $200 3 different times, and so each time we added to cash, but the other side of the transaction was different in each case. One time, accounts receivable came down because we had already done that work and we had a receivable for it. The second time, we added the revenue because we were just now doing that work. And then the third time, we added to a liability because we still have not done the work. We owe them that service. So the point I'm trying to make is that we are not recording the same information twice. The $200 added to cash, that tells us that cash went up. The other side of the transaction tells us why we collected that money. So, again, we're not recording the same information twice. Each item tells us a new piece of information. When we get to the end of July, we need to depreciate the lawnmower, another 1/3 of the lawnmower has expired, so we're subtracting 100 from the lawnmower column and subtracting 100 as depreciation expense. And then finally, at the end of July, we paid a $20 dividend to the owner. That decreased cash. It also decreased how much of the retained earnings we're keeping, so we subtracted that. Okay, we're going to make our financial statements again. Let me get this picture out of the way. We go up to the retained earnings column and we look through and pull out all the revenues and expenses. That's what goes to the income statement. And again, that expense, I'll just say, we want to be specific with the different types of expenses that we have. If you had multiple expenses, you would have a different line item for each one. So you might have a line for depreciation, a line for wages, a line for rent expense, a line for insurance expense, and so on. Now, this income statement covers the month of July. So again, you want to be clear about what time period you're looking at. Revenue minus expenses is our net income. Then we look over at the statement of retained earnings. This time we started with 90. That was what carried over from June. That was our beginning retained earnings for July. And then we add the net income that we already calculated on the income statement. Subtract the dividends. Again, that comes from the retained earnings column. Subtract the dividends in July, and that brings us to our ending balance, an ending column balance of 170 on July 31st. And finally, the balance sheet at the end of July. The status of the accounting equation. We would list out what assets we have, cash and the lawnmower, total assets of 870. This time we have a liability of 200. And then we have our common stock amounts, 500. The retained earnings is now 170. So the total stockholders' equity is 670. And add in the liabilities, and you see that our total liabilities and stockholders' equity is equal to our total assets. So again, that's the balance sheet is the status of the accounting equation at the end of the month. And finally, we go into the month of August. The column totals at the end of July become the beginning balances for August. And then we will record what we did in that month. The first thing we did was we mowed the yard that we had already been paid for. So that reduced this liability, took care of that. And since we did the work, we are recording revenue of $200. Because remember, you always record revenue when you do the work. So we mowed the yard, and that took care of that liability. That's the only thing we did in August. So we then depreciate the lawnmower for that last month. And we also pay a $30 dividend. And so when we get to the end of the month, the only asset we have left is cash of $740. No other assets, no liabilities. And the $740 is matched by we have that $500 investment from the owner, and retained earnings now adds up to $240. Again, that represents the $100 each month. That'd be $300 minus the $60 of dividends that we paid throughout the summer. So that's the ending balance of $240. We can summarize the month of August on an income statement for the month. Again, go to the retained earnings column, pick out the revenues and expenses, and that's what we had for the month of August. That net income is carried over to the statement of retained earnings and added to the retained earnings we had at the beginning of August. Subtract out the $30 of dividends, and there's our $240 ending retained earnings. And then that $240, again, that's what's going to be reported on the balance sheet at the end of August. And that balance sheet, again, is the status of the accounting, the column totals, the status of the accounting equation at the end of August. So we've prepared financial statements for each month. What if we prepared income statements for the entire summer? So if we want an income statement for the 3 months ended August 31. So I've got those down here. So here would be the financial statements for the entire summer. The quarter ended August 31. We had revenues of $600 throughout those 3 months, minus the expenses. And again, you should be specific. Not sure how I did that. So our net income of $300 would be added to our beginning retained earnings, and at the beginning of the summer it was 0. Subtract the dividends for the whole summer of $60, ending retained earnings of $240, and then that's the retained earnings that appears on the balance sheet as of August 31. So again, the balance sheet at the end of August is the same as the balance sheet at the end of the summer. It's simply the status of the accounting equation on August 31. But the income statement would depend on what time period you're covering. Are you covering just a month, or are you covering 2 months, or the whole summer? And the statement of retained earnings would cover the same time period as the income statement. So that gets you through the example of Chapter 1. I would urge you to go through that slowly, step by step, on your own, again, to make sure you understand. We cover some really important concepts that will be applied over and over again in various situations. So in the next video, we will work through a sample problem to record transactions again.